There's been a ton of buzz about portable mortgages and if they're coming to the United States and if they're going to save the United States housing market. Homeowners are getting excited about the fact that they're going to be able to take their 3% mortgage rate and go buy another house with it. This is not going to be the case. So in this video, I'm going to explain to you why I do not think this is the right move and why I think this will do more harm than good for the United States housing market. First, let's talk about the 30-year mortgage in the United States. 30-year mortgage in the United States has what is known as a due on sale clause. That clause requires you to pay your loan off in full when you sell your current property. You cannot transfer it and you cannot take it with you to another property. A portable mortgage is exactly what it sounds like. It is a mortgage that you can bring with you to your next home when you purchase a new home. Instead of paying off your old mortgage when you sell, you simply port your current loan with the same interest rate to your next home you buy. Now, portable mortgages do exist in places like Canada, the UK, and Australia, and they do help the housing market continue to move even during high interest rate environments. On paper, it sounds like a dream solution for the United States. However, our mortgage market works completely differently. Now, the U.S. mortgage market is built off of one thing, and that one thing is called securitization. Now, what does this mean? This means that banks originate the loans then get pooled together. From those pooled loans, they are sold off to investors as mortgage-backed securities, and then government entities like Fannie Mae and Freddie Mac guarantee large portions of these pools. The value of these pools depend on a couple of things. 1, the specific property backing the loan. 2, the risk portfolio of the borrower. And 3, the predictable timeline in which these loans will be paid off, which right now in the United States is typically every 7 to 10 years. Now, say you have a 3% mortgage today and you want to port it from one house to another. An investor would no longer be able to assess a collateral risk, which means the entire risk profile of the pool that your loan is involved in would go out the window along with the logic of securitization. Banks would no longer get paid every time a homeowner moves, which means investors would be holding on to the loan for 30 plus years rather than the 7 to 10 now. So the expected cash flow of the mortgage-backed security would break, and investors would require a much higher interest rate to compensate for this, which means interest rates across America would rise. Meaning that if we were to make your 3% loan portable, it would raise interest rates for everybody else and destabilize the exact system that we use for the 30-year mortgage today. Now, in the short term, yes, this could help. This would mean that more people that are locked into their low interest rate in between 2 and 4% would move and increase inventory for the rest of the people, meaning that more transactions would happen. But as we spoke about earlier, in the long term, this could cause interest rates to rise, loans to become more expensive, and buyers would build equity much slower than they do in today's economy. Now, I want to be clear, I'm not saying something like this can't come out down the road, but it would be very hard to take your 3% mortgage and make it portable without completely blowing up the current mortgage market. And if something like this does come out down the road, you have to understand that you might be paying a higher interest rate, so banks can make it more appealing to investors on the back half.